Well, thanks for coming out. I'm sure you're here for different motivations, and it's been a long time since I bought my first home, my wife and I, but I remember what it was like to kind of go through that process. I was actually in this industry at the time, so I knew a lot more about what it took to get a mortgage and what that whole process was all about than your average person, since I worked in the industry. But even with all of that knowledge, it still is, it's a big decision, and there's all these little moving parts you have to try to figure out. And that's really what I think the credit union can help you with, is making it a little bit simpler, a little bit easier. And my objective really tonight is twofold. So first of all, just let me tell you quickly what my background is. I've spent the last, 25 or so years in a role either directly or related to what's called underwriting. Now, underwriting, if you've never heard of a person who's an underwriter, that would not be a surprise. There are not children running around outside today saying that when they grow up they want to be underwriters. That just doesn't happen. But basically what an underwriter does, whether it's with an insurance company like us or at a different kind of an organization, is they assess risk. So they basically look at the facts that are presented to them and decide, is this a risk that's willing to take? So for our purposes, you all represent a potential risk to the credit union if you want to borrow money. The risk to the credit union is that you may not pay them back. And so they have to try to figure out when you apply for any kind of a loan, are you a good risk? Are you a person that they think will pay them back? And underwriting is that decision-making process. So it's about looking at all of those characteristics about a borrower, about the property that you're buying, and trying to figure out if this is a loan that should be made. Now, unfortunately, it's not completely up to the credit union entirely as to who gets a loan and who doesn't, because there's this whole part of the mortgage industry that kind of sets all the rules. There's governmental agencies and there's regulators and there's all of this kind of outside influences that dictate what the folks here at the credit union can and can't do. So sometimes when people can't get the yes that they were expecting, it isn't even necessarily because that credit union or that lender didn't want to help them. It's that there's some rule somewhere, maybe set by someone in Washington, D.C., that is actually preventing that person from being able to get a loan. But again, you don't have to really worry about all those details. I'll kind of walk through with you what I think are some of the steps, the keys, to putting you in the best possible position to be able to take advantage of exceptionally low rates and housing that's much more affordable than it was a few years back. I'm not sure how this local market has performed. I'm actually from the Chicago area, but the values in Chicago have come down considerably from what they were, maybe 5, 6 years ago. So it's actually a really good time to be kind of interested in this process of buying a house. And even if you ultimately decide that no, this isn't the time, or no, you're not quite ready, just hearing what you're going to hear tonight will help you do the things that will put you in a much better position when you are ready to do that. So I really kind of have two objectives. One is to help you better understand this decision. How is this decision made? What does a lender base that off of? And there's really just some fundamental keys that I can share with you about that. I'll also give you some suggestions as to how you can kind of improve in any of those areas that maybe are a personal weakness for you right now. And I also came up with a list. It's not specific to mortgages, but it's just a list of kind of the top 10, what I consider to be most important financial lessons that I wish I would have known 25 years ago. It just took me a long time to figure them out. And I thought that would be worth sharing with you guys so that you can maybe learn from my learning curve as opposed to you having to figure those things out on your own. So that's kind of where we're headed. If you have questions about anything that I share, so anything that I say, if you have a question you're not sure what that meant, or if I use an industry term that you're not familiar with, sometimes stuff will slip out that I don't realize isn't the language that you use in your business, let me know, right? This is informal, so you guys can participate as much as you'd like. If you have questions about like individual scenarios that apply to you in getting the loan, those would probably be best addressed with the folks here at the credit union, because ultimately they'd be the ones who'd be working with you to try to get the loan, okay? So some of the questions, you might ask me something and I might defer it, and it's just because I feel that it's probably more appropriate for the folks here to answer that. But anything that comes up, doesn't matter what the question is, just ask, all right? Does that sound fair? All right, so let me just kind of start with some key ideas. And excuse me for using notes, but I literally just recently kind of decided what it was that I thought I would share with you. This is not an audience that I typically speak to. I'm usually training folks like the mortgage department here at the credit union how to do mortgages more efficiently and effectively. So it's a rare opportunity that I actually get to speak to the people that are getting the mortgage. That's kind of a treat. But because it's not a standard presentation, I kind of had to jot down some notes as to what I wanted to say. In a very broad sense, okay, any company that you go to for a mortgage is going to be looking at a few key things. And I think in your folders there is a notepad and a pen, so if any of this stuff is stuff you want to remember, just jot it down. They're going to be looking for your ability to repay. So, and we'll get into a few more details as to what is that exactly, but that answers the question, can you repay this loan? So that's one of the key questions that any lender is going to have when you want to borrow money. Do you have the ability to repay? Can you repay the loan? They're also going to be looking at your willingness. You're thinking, well, aren't those two kind of the same thing? Let's think about this for a minute. There are some people who have the ability to repay debt, but choose not to, for whatever reason. And there might be people who don't really look like they're able, but yet, sure enough, every month, they're always making their payments. So it is really kind of two different questions that have to be answered by the folks here at the credit union. As they evaluate all the information about you, they're asking, can you repay the loan, and will you repay the loan? And then finally, and this might be kind of most important for everybody, whatever loans they do make need to be sustainable. Now that's not a word we use very often, so let me just describe what I mean by that. That means that's a good loan for you and it's a good loan for the credit union. So it's a loan that they're likely going to get repaid, they made the right decision, and it's a good loan for you. It doesn't burden you, it doesn't strain you, stress you. I don't know how many of you know what's kind of happened in the mortgage industry over the last decade, but we've gone through a lot of changes. And we went from an industry that used to be pretty tight, meaning, you know, not just anybody could get a mortgage. You had to meet a lot of different criteria. And we kind of went from that world to almost anybody could find their way into a mortgage. You might have even heard of some friends or relatives that took advantage of that time when, I mean, there were even loans that were available where a person didn't even have to prove how much money they earned, which to me seems kind of crazy now looking back. Like, why would you make a loan to someone when they don't even have to prove how much money they make? But there were actually loans during that period of time that were like that. That didn't turn out so well. That turned into a lot of loans that really were not sustainable. They weren't good for the borrowers, but the borrowers were emotionally attached to a house. They really wanted it. They didn't know what they could afford, and the lender was willing to give them a loan. Didn't end up being very good for either party. So what happened as a result of all of that was a lot of foreclosures, a lot of delinquent loans, and so the industry has kind of gone back to, well, let's tighten up a little bit. But it's not nearly as tight as it has been. And I want to stress that. This isn't nearly as difficult or as stressful as you might think, just getting a mortgage. And the media doesn't do us any favors because the media likes you to read their articles and their headlines. So they tend to say things that are very kind of sensational, and unfortunately they make it sound like it's really hard to get a loan and credit is tight. That's a phrase that they'll use a lot. It's tight, it's hard to get credit. I don't really think so. Just looking at my 25 years of perspective, I don't think it's that hard. I think this is actually an amazing time to try to do what you guys are thinking about, especially because of the low rates and especially because of the affordability of housing. And as far as these rules that you have to follow, here's the one thing that you may ultimately, even at the end of all of it, say, that was a little more than I was expecting. And that's the word documentation. That's kind of a big thing in our business, much more so than if you get a car loan or a personal loan of some kind. When you want to borrow tens or hundreds of thousands of dollars, your lender, your credit union, is going to ask you for a lot of documentation. And most of the documentation is to prove what you've indicated are the facts about your employment and your income and your assets and your credit. And all of those things that you're disclosing have to be proven. And sometimes people aren't prepared for that. They didn't realize that there was all of this paperwork. So I will tell you that if there's anything that's difficult about getting a loan today, it's that you have to be prepared to deal with a lot of paperwork. Right? There's a lot of forms you'll sign, there's a lot of paperwork you'll have to produce, but it's all understandable and doable, especially if you have the mindset at the beginning that this is what's required. You can't just walk in and borrow hundreds of thousands of dollars without having any paperwork. Okay, so just be prepared for that. All right, so let's talk a little bit about the factors that affect the decision. And this is the kind of stuff that probably due to lack of sleep I think of these things, but I came up with an expression or a phrase that will help you remember these half dozen things. And these truly are the half dozen things that will make or break a person's ability to get a mortgage. So what you're striving for is to be as strong as possible in all half dozen of these things. You don't have to be perfect in all areas, in all 6 of them, but as much as possible you want to have strength in each of these. Kind of think of them as pillars, right? Pillars supporting a building. And you want the pillars to kind of be of equal strength and equal height, but the reality is most of us aren't that perfect. We have some things that maybe are strong about our financial situation. We have other areas that maybe aren't so good, but that's okay. The goal is to try to get all 6 of these to be as strong as possible. And here's the expression. You remember nothing else. The expression that I hope you'll be able to just recall, right? So if somebody asks you in a couple of days, oh, you went to that seminar at the credit union, what can you tell me about it? You might remember this. Dogs can sit, dogs can run. Now, if you have a dog that can't do those things, just put can't instead, because it really doesn't matter. What I'm basically doing is creating an acronym that will spell out the 6 different things. So if we just take the first letters of these 6 words, right, those are going to be our acronym. So DCSDCR. If you just remember dogs can sit, dogs can run, and remember the first letter of each of those words, that would at least give you the 6 letters that will describe the 6 pillars that we're talking about. Okay? So we'll walk through that. All right, we're going to start with the first D. All right, dogs can sit, dogs can run. And the first D is your down payment. Now, as you heard a few minutes ago, you can actually get a mortgage today with as little as 5% down, even 3% down. That's remarkable. Now, if we compare that to, oh, I've heard of people who got a mortgage with no money down, 5 or 6 years ago. Remember, those times are kind of not relevant to today. Historically, just go back in time, ask your parents, ask your grandparents if they're still around. When they bought a house, how much did they put down? People tended to put 30, 40, 50, 60% down. And they could only take out loans for a short period of time, 5 years, 7 years, maybe 10 years. So the fact today that you can buy a home with only, say, 5% down, or even less occasionally, and stretch that loan out over 30 years is a remarkable thing. And what that allows is for more people to buy homes than have ever been allowed to buy homes before. Because if you have to make a big down payment, that's going to be a hurdle for a lot of people, right? I mean, what would you say is the average home value in this area?
Average home value,
I know it depends on the neighborhood, but just on average.
I think right now popular price range is like $80,000 to $100,000.
Okay, so let's even just say a $100,000 home. If you had to put 20% down, $20,000, it takes a person a long time to accumulate $20,000, right? Most of us, if we found out today that we had to save up $20,000 before we could buy a house, that's a lot of years down the road. Well, that's what people used to do, and that's why a lot of your previous generations of family members may not have bought homes until they were much older than you might be. Part of the reason being they had to accumulate a down payment. All right, so there are a couple of things, though, that I want you to know about this down payment. The more you can put down, the stronger that pillar becomes. So it's okay to just have the 5% or even the 3%, but then that pillar itself isn't a very strong pillar, right? So then the other 5 things we're going to talk about, those also can't all be a little weak, because we don't want all of them to have a little shakiness to them. We want some to be really solid, especially if some of them are not as solid. So this is just one of 6 things, but this is a fairly important one. If you can make a down payment of at least 5% or 10%, that's better than 3% or the folks who are trying to get loans with no money down. Okay? Just a couple of things that I'll say about the down payment, things that you may not know. We take it for granted in this industry because we work with this all the time. as you're accumulating this down payment, as you're coming up with the funds that are necessary to put down on a house, if it's not just depositing extra money from your paycheck, if you're doing other things to get a hold of that money, if you're getting a gift from a family member, if you're selling a third car that you don't really use, or a motorcycle, or something that you don't really use and you could get a couple $1,000s for it, if you're saving some of your paychecks at home so that you won't spend them, and you're waiting until you're ready to buy a house so that you'll put them all in your account, that documentation word I had up before, any lender is going to want to know about all of those things that you did to accumulate the money. So it's not simply showing a statement that says, on this date I have this amount of money. They're actually going to go back in time a few months and look to see, were there these kind of strange, unusual deposits into your account? And if there were, you need to be prepared to be able to say, where did that money come from? And maybe even have some documentation to back it up. Like if you sold something, it's not probably going to be good enough just to say, well, I had this motorcycle that I sold to some guy. You might actually have to have like a bill of sale or something that shows that you actually indeed sold that motorcycle. And the reason that all that documentation is required is to make sure that the lender knows, where did this money come from? Right? We want to make sure that it wasn't stolen or wasn't, where did it come from exactly? So that's something that a lot of people have no idea will be required, because the only thing that will probably be in your mind is, how much do I need by what date? And then you're going to go make that happen. Just remember that the lender might have some questions about, where'd that come from exactly? If it isn't just your regular savings. Now, if you happen to have a pool of money that's just sitting in an account right now and that's your down payment, and it doesn't really change much because you've already got it, then you really have no worries. It's only when you're trying to get a hold of all of this right before you close on the home that the lender's going to ask questions about, well, where exactly is all that money coming from? And you might have to document. Okay, so that's kind of the thing that most people out there, most people in your situation don't know. You can actually borrow some of that money. It would be preferable that you saved it, but let's say the mortgage payment that you're going to have is about the same as what you pay in rent right now. So it's not like this buying a home is going to be a big stretch from what you're accustomed to, and so you haven't really been able to save a lot of money, but you've got a 401k plan. A lot of people might borrow from their 401k plan to come up with the money that they need for a down payment. So the only stipulation is, if you're going to borrow the money that makes up your down payment, it has to be a secured loan. So you can't take a cash advance on your credit card. You can't just get a personal loan from the credit union and then say, okay, here's my down payment. It has to actually be secured by something. So whether it's secured by an asset like a 401k plan or an IRA, or whether it's secured by a car that you own free and clear, that is actually a way that you can accumulate a down payment. So keep that in mind, especially if you're really close to getting that amount that you needed and you don't want to wait any longer to take advantage of the rates and the houses that are out there right now. And I've shared this with a lot of groups over time, and I've gotten some really interesting feedback, because many of the people that I speak to, I will see more than once over a period of several years. And I'll share this with you. This is a study that was done by Stanford University. And what the study concluded is that if you do what I'm going to show you, you will likely save 50% more than you're saving right now. That's pretty sweet, right? So if you'll just follow the steps I'm going to share with you, you'll save roughly 50% more than you're probably saving right now, if you're not already doing these steps. So let me just lay them out for you. Make a list of your goals. Now I'm speaking financial goals. So for instance, buying a house is probably one of them. But maybe there's others. Maybe could use a new car, mine's getting pretty beat up. It could be paying off my student loan debt. It could be, I'd like to go on vacation once in a while. It could be, I'd like to save up to go to college. Just make a list, probably half dozen things at the most, that are kind of those key financial goals. The stuff that, this is what I'd really like to achieve financially. Then, open up named accounts for each of those. So if you have a goal of becoming a homeowner, open up a house account. If you have the goal of buying a new car, open up a car account. If you have the goal of going on vacation someplace, open up the vacation account. So in other words, what I'm suggesting is don't just take whatever you have left in your paycheck and throw it into an account, but actually have named accounts. Now, when my wife started doing this, she's been managing our household money for most of our marriage. I thought she was out of her mind. I thought she was crazy. I thought you're creating extra work for yourself. You're driving the people at the bank crazy. You walk in there with all these passbooks, you know, $5 here, $10 here, but just put all the money in the account. And she was adamant, no, this is the way I want to do it. And I didn't understand until time passed that what happens is that if you make regular deposits, now this is the discipline part, right? And if you can make this automatic, you know how if you have a job that offers a 401k plan and they'll just take that money out of your check before you ever see it, that works a whole lot better than I have to physically go and put money somewhere. So if you can make some of this stuff automatic where it just happens, it's more likely you'll do it. But this is the discipline part. This is where most people wouldn't keep going, right? It's one thing to come up with your list. It's another thing to open up all these accounts. But ultimately, you have to make regular deposits. Now, real life is that some months, maybe a couple of those accounts don't get anything because you needed new tires on your car. And so you don't have any extra money, right? Or you change the amounts that go into those accounts based on what you're earning. But the discipline of regular deposits into those accounts, what Stanford found is that because of not only the physical putting money in the accounts, but even psychologically, we end up saving more money. It doesn't just disappear as quickly. You know how, I don't know if anybody's had this, it's a phrase I call too much month at the end of the money. You know, it's like, I don't know where it went, it just went. And sometimes it's not the 30th yet, you know, it's the 25th, and I'm done, I have no more money. How'd that happen? This kind of prevents that from happening. So it sounds really simple, it sounds like, well gosh, that's an easy thing to do, but the people that do that save 50% more than the people that don't have that plan. So if you've had trouble saving, and a lot of people do, that may be a way to increase your savings. Okay, all of that is to speak to this first pillar called down payment. All right, let's talk about, we're going to go all the way to the sixth pillar. And let's talk about kind of the inverse of that, which is what's called reserves. So you have a certain amount of money to work with to buy a house. Some of that money is used to actually buy the house. Whatever's left, that's what in our world of lending we call reserves. This is the money you have left over. The goal is you shouldn't have to buy a home and wind up with a dime left to your name. You should be able to make a down payment and have a little bit of money left over. And especially when you're a first-time buyer, this was my experience, I had no idea all the stuff that I was going to have to buy or spend money on because I'd never owned a house before. I mean, you might have lived with your parents at some point, but you weren't paying attention to all that stuff. I mean, simple stuff like you have to buy a hose or a rake or a lawnmower, or you have to pay a water bill. I mean, stuff that maybe you didn't have to do when you were renting. So if you buy a home and put every dime you have into the down payment and have nothing in reserve, what people will end up doing is putting all that stuff they have to do initially on credit cards. And now you're already accumulating credit card debt and having to pay high interest rates. And so the idea is to have a balance here. There's a certain amount of the money that you have that will be down payment, and then there's a certain amount of the money that will be left over in reserve. Now, if you're making a smaller one of these, then you should have more of this. Right? Think about it. It's kind of like a teeter-totter. Is that the right expression? You've got a certain amount of money. If you put more money down, right, you'd have less in reserve. If you put less money down, you'd have more in reserve. They affect each other inversely. So if this is strong, that's going to be weaker. So it's up to you and the lender to kind of figure out what's the right balance there between down payment and reserves. But you should have something left over. Now, the good news is this doesn't have to be sitting in a checking account. If you have like a 401k plan or an IRA, even though that's obviously for retirement and you wouldn't be wanting to touch it now, that is a financial reserve. In other words, if you had a hardship, if something happened to you that was unexpected, you could go get that money or borrow against it. So that counts as a reserve. But that's just something to keep in mind. Don't put every dollar to your name in down payment. have a little bit of something left over. The best ballpark number I could give you is a couple of months of a mortgage payment. That would be a good starting reserve. So if your mortgage payment is, what's a typical mortgage payment based on your taxes here?
Oh, Blaine, I don't know, depends on what the.
Yeah, that's true.
Let's just say, let's just say like 600.
600? Okay, so you've got a mortgage payment of $600, and I'm suggesting you have a couple months worth of that left over in reserve. That's a little over $1,000. So you'd have your money that you're putting down on the house, but you'd want to still have a little over $1,000, fairly accessible money that you could get to if you needed it. That's a good rule of thumb, good ballpark number. Okay. Any question about those two things? That's really the asset part, the money part of a loan file. Your down payment and your reserves. Or anything that I've said that's confusing, anything that needs to be clarified, any questions? Okay, so those are kind of two of the 6 pillars that this loan rests on. What does your down payment look like? What do your reserves look like? And remember, when you strengthen one, you automatically weaken the other. So it's a balance between those two. Okay, let's talk about another couple. Credit. Yay, credit. Everybody's favorite topic. Because this is personal. Credit demonstrates that willingness to repay. So on a previous page, I had ability and willingness. Your credit history, whether you agree with it or not, to the lender demonstrates how willing you are to repay your bills. Now, you might have a long list of reasons why you haven't paid some bills on time. You might have had some difficult times that you went through. You know, maybe you had some medical challenges, or you were off work and you couldn't keep up with your bills. And so to you, you might be thinking, well, I did the best I could. Why should that be held against me? Remember, they're looking at how have you paid your bills before. And if that doesn't look very good, it's hard for a lender to extend you more credit when the credit that you've had hasn't been paid on time. So there's a lot of different variables that go into that credit score, and one of the pages in your folder actually speaks to 5 different things that affect your score. I just want to focus on 2, because these 2 things account for 2/3 of your credit score. By the way, credit scores are not created equal. If you do any searching online, if you read the newspaper, if you hear people talk about credit scores, many times those are actually not the same scores that are used when you go to apply for a mortgage. There's different models that have even different numeric ranges. And if you get free credit scores online, those are almost never the ones that are used when you go to get a mortgage, because those you have to pay for. If you want that kind of credit score, a lot of times you have to pay for it. So if you get a free credit score online somewhere, it could be a completely different model. So it might say something like, your credit score is an 850 on a scale of 0 to 1,000. And then you walk in here, and they pull your credit and say, oh no, you've got a 700 credit score. And you're thinking, well, wait a minute, I just saw mine, it was 850. It's a completely different model. So that may confuse you, right? It's important that you know what your credit scores are that apply to if you're getting a loan, because those are the ones that are going to be used. So the fact that you can have them at any time, even just look at your credit, even without a score, just looking at your credit, that's a great service that's being provided. I would take advantage of that. Okay, so here are the 2 things that are going to affect that number the most. 2/3 of the number are based on these 2 things. Your payment history. That's like the no-brainer, right? The due date, that due date on a statement, not a suggestion, right? You pay it by that date. Now, there's times when you can't. There's times when you have too much month at the end of the money. It happens, right? You may have a whole section of your life where you weren't able to make your bill payments on time. If that was long ago, probably not a big problem. If that was more recent, then you have to put some distance between you and those problems that you had. Right? So everybody, I shouldn't say everybody, I think most people have a spot in their life where things aren't very pretty financially. We make mistakes, we get in over our head. But that's fine if that's, say, a couple years ago or more. But if that was 6 months ago, 3 months ago, what you're probably going to be told is get some space between that trouble that you had and good credit. All right, so your payment history is really, really important, paying by the due date. Second thing, the amount of debt that you carry. And kind of the cardinal sin here are credit cards that are maxed out. Credit cards are convenient. One of the beautiful things about a credit card is that it enables you to get just about anything, anytime, as long as you still have a balance, a limit that you can still, charge up on that credit card. The downside is, because it's so easy, people accumulate balances kind of almost without realizing that they're accumulating these big balances, the balances that you can't just pay off every month in full. So even though you have a credit card limit, let's just say as an example, you've got a credit card, I'll use my daughter as an example. She has a Discover card. When they first gave her the Discover card, she probably got it when she was around 18, 19. She had a $500 limit. That's not a lot if you need to buy a few things, right? They never really extended her credit automatically, so we suggested to her, now that you've had the card for a few years and you've paid it on time, why don't you contact Discover and say, hey, is there any way that you could raise that limit? Well, they jumped her from $500 to $2,000. So now she has a $2,000 credit card limit. If you go from $500 to $2,000, you're feeling pretty good about that, and it might encourage you to say, go buy that Apple computer that's going to cost $1,800. I'm still $200 under my limit, feeling pretty good. If your balance even gets beyond, say, 50% of the limit, so that $2,000 card, if it even gets to $1,000 or more, nothing wrong with doing that, but it starts affecting your credit score. Again, most people don't know this. They think, I'm well below my limit, what's the big deal? It starts actually affecting your credit score. So what you want is maybe a few different cards with lower balances on each than only one or two cards that are constantly maxed out, if you're looking to improve your credit score. And there are people who've always paid their bills on time that actually don't have a very good credit score because of this second reason. They've got too much debt and too much on credit. So the two pieces of advice that I would give anybody who's trying to improve their credit score is make sure those bills are being paid on time as much as possible, and make sure that you don't carry an enormous amount of credit card debt. Bring that stuff down as much as possible, because that's affecting your credit score. Even if you pay your bills on time, it's still affecting your credit score. This is a pretty big deal in getting a loan. This credit history, pretty big deal. I was ignorant to all of that stuff. I didn't grow up in an environment where any of that was really happening, and nobody was telling me what was good and what was bad and what I should do. So, it took me a lot of years of kind of just continually beating my head into walls for me to figure out how to deal with all of this. And it didn't hurt that I married somebody who came from, a very financially responsible family, and they kind of understood how all this stuff works. But if we don't have that modeled to us, we don't know. Right? So a lot of our habits are just based on what we've picked up along the way. So if this has been a struggle for you, the good news is time heals. So you can get on your feet, you can start today making sure that you pay your bills on time, you don't charge up your cards too much, and even if things today look not so good, over time, that not so good today won't be that big of a deal because it'll be yesterday. All right. One other thing, I'm going to add a website. There's one website on one of your handouts in there, it's the myfico.com website, where you can get all kinds of information about credit. Let me just give you another one that you might like just as well, Experian. Experian.com. Between that one and the MyFICO, which is already listed for you, you'll get about all the credit information you'd ever need. How the score is computed, not like technical details, but what goes into the score, myths versus realities of credit scores, all kinds of stuff on there. Plenty of information about credit. The one other thing that I will say about credit is that if you have had a difficulty, one of the things that the credit union is going to try to understand was it extenuating, or was it mismanagement? Now, we all have different definitions, right? When I owned a car that I couldn't afford as a young man, and realized I need to sell the car so I can just pay them off completely, I figured because I'm going to pay them off completely, why do I need to make payments? Foolish, but that was my thinking at the time. So if you looked at my car payment record at that time, it wouldn't have looked good, but I might not have seen that as I was mismanaging. In fact, I was trying to sell the car to pay them off, right? I would have thought that's more an extenuating circumstance. No, an extenuating circumstance is you've lost your job, you've become ill, right? You've had a natural disaster that wiped out, personal property that you had. Those are extenuating circumstances. Mismanagement basically are choices and decisions that you've made. And we don't judge those. We don't look at you and say, oh, well, you don't know how to do what needs to be done financially. But the reality is, if you had a role in what's happened on your credit report, that's kind of the mismanagement category. If you couldn't control what happened on your credit report, that's more the extenuating. And as you can probably assume, these are looked at a little bit differently. The biggest effect that this has on you is how long ago does that have to have been? So if it was due to extenuating circumstances, not as long of a wait as if it was due to mismanagement. So that's just something to keep in mind if you've had any struggles. All right, any credit questions? We could go on and on forever about credit, but I'm going to try to cap it there. All right, so now we got 3. We've got half of them. Down payment, reserves, credit. Let's talk about another aspect of credit, which is your level of debt. There is a very specific number that the credit union will calculate. It's called, I don't even know how much of this you want to know, but it's not bad to know the acronyms. DTI, debt to income ratio. It's a simple calculation, actually. It's the amount of monthly debt payments that you make in proportion to your monthly income. So what percentage of your income every month goes out to credit cards, student loans, car payments, personal loans, those kinds of debts? Doesn't look at things like utilities, insurance premiums, gasoline, food, clothing, right, your cell phone bill. All of that stuff is what everybody has, pretty much. But what we all kind of differ in having is how much debt do we carry? How many loans do we have? How many credit cards do we have? You don't want to extend yourself here. And even if you're very comfortable with the amount of debt that you have, you may have more than this magic number that the lender is going to calculate. So that's a pretty hard and fast rule in the mortgage world right now. We got away from that in the easy loan days, where we kind of just let people, if they had a good down payment, and they had good credit, and they had good reserves, we just kind of let people do whatever down here. And what we learned was, that's not good for you, that's not sustainable. Because the only time you can sustain debt that's a high amount is if you stay employed, stay healthy, stay married, right? All that stuff has to stay good. If any of those things get a little rocky, that's when the house of cards falls down. So we've learned our lesson from the meltdown that we've all lived through in the mortgage world over the last decade, and we've decided, you know what, we need to rein that in, make sure that people don't overextend themselves. So it's not about what you're comfortable with, it's about what does the industry say is the amount of debt that you can have. What you may find is that that number is even higher than what you're comfortable with. In the Midwest in particular, in this part of the country, people tend to be a little bit more conservative. We don't spend as much on some things as different parts of the country do. So you might actually be told that you qualify for a loan that's more than you want, right? But for some people, this is their challenge. So if that is a challenge for you, you may have to bring that down. Before you can get the mortgage, you may have to actually work on paying down or paying off some debt. One challenge that I think many people will have over the next decade is student loan debt. Because as some of you might know, personally, or people you know, people are carrying a lot of student loan debt, right? And once that has to start being repaid, that's a lot. That's over and above everything else that you're trying to do here. So just be mindful that you don't want to have too much of that, even if it feels okay. I can make these payments, I'm doing all right. Too much to the lender is going to be too much. All right, there's another one up here. We're going to call it stability. which means they're just going to be looking at your overall life, your job history, where you've lived, your credit history, the money you've saved, and look for a sense of stability. And one of the most important things you can have stability in is income. That may not seem obvious, but think about it. Your ability to repay this loan is based on your ability to earn a consistent income. So if you have to repay a loan that's $600 or $700 or $800 a month, you have to be able to consistently earn an income that could pay that back. So that's one of the things, that's another kind of key pillar that the credit union will look for is stability. Now remember what I said at the beginning. You don't have to be perfect at all this stuff. Right? As many as possible, the better your odds. But if some of these are weaker than others, that's when they really do their work and roll up their sleeves and try to figure out, is there any way that we can get you what you want now? Or do some of those things need a little help? So here's some coaching on what to go do so that you can come back when you're in a better position. The last of the 6 really doesn't involve you directly, and it's the collateral, which is just a fancy way of saying the property, the appraisal, the house you're buying. The credit union's going to want to make sure that that is sustainable for you as well, that you're buying a home that's in good condition. I mean, you might want to buy a fixer-upper, but if it's too much of a fixer-upper, you're not going to get a mortgage for that. Because, again, we're always thinking about if something were to happen to you and you couldn't pay it back, what have we got? What's there? And if it's a house that's gutted that needs a lot of work, that can't really be sold to that many people. You might have bought it because you know how to do that work and you're into that, but your average person would see a house that's gutted and needs a lot of work and say, no, I don't think so. So they want to make sure that the condition is good and that it's comparable to what's in the neighborhood and that you're not buying some white elephant, some piece of property that's so unique and so different that there's nobody out there else besides you that would like it. You don't directly influence that other than the property that you choose. But the credit union is going to be looking at the collateral. So they're looking at all this stuff that involves you, and then they're also looking at the collateral to make sure that that's right for you and right for them as well. Okay, so you don't have a lot of control over that one, but it is part of the decision. So those are the 6. And I do think we have our acronym, right? It may not be in order, but right. So there's a dog can sit, and a dog can run. Okay, so if we wanted to put them in order, I guess I'd slide collateral up there. Hopefully some of that will stick. So that's the stuff that you need to work on. Bring that stuff to the table. The house doesn't have to be perfect. For some reason, my wife and I are attracted to houses that have potential. So we've only owned 2 homes, but they both were homes that once we bought, I mean, here's what a realtor who didn't have a lot of tact said when we bought our first house. You're not going to live there right away, are you? Like, well, it's not uninhabitable. It just needs new carpeting, and it needs wallpaper, and it needs paint, but it was totally fine. So you can buy that kind of a house. I don't want to make it sound like you've got to buy the perfect property, but structurally it has to be sound. Can't need repairs, can't need things that are supposed to be finished, right? That kind of stuff has to be done. Okay, here's the last thing I want to leave you with, and then we'll kind of turn you over to the credit union folks. The 10 steps. And this is literally just my opinion. So this is not an official list. This is just, based on my experience, I thought, what are kind of 10 financial lessons that, had I known this stuff earlier, could have saved me a lot of time and grief. There's something in learning things on your own, but if I can give you the 10 things, you'll probably be better for it. And there's no particular order here. So you might want to jot these down and share this stuff. I mean, share some of this with the people that you know that aren't here. Okay, here's one. Live within your means. Live within your means. In a nutshell, that means don't spend all you make. Or more than you make. Make sure that you are creating a lifestyle for yourself that is sustainable. It's within what you bring in. Right? That to me is living within your means. By the way, there's a third of the population, based on current studies, a third of the population out there that's not doing that. They're not living within their means. There's really no way to make progress right? There's no way to get loans. There's no way to buy a home. If you're not living within your means, it really limits your ability to really go anywhere from there. So at a very basic level, I would suggest you do that. Number 2, understand credit scores. We talked a little bit about it. There's more information in your packet. You might get some more information here at the credit union, but understand what drives the credit scores, how to get them better if yours isn't where it needs to be. As much as we think, hey, it's just a stupid number, it's important. You know, it's just an important number to know. I used to joke that, you know, the new pickup line in bars would be, what's your credit score? Because it's just it's a financial indicator of your responsibility about managing debt. And to a lender, that's extremely important, right? Okay, so I would know that. Next, pay yourself first. Pay yourself first. You probably heard that. That was this. No, not there. That was this. All right, that was just making sure that before I pay everybody else and it's all gone, I've lived within my means in such a way that there's something that's also for me. I'm also paying myself for my future. Next, prepare for adversity. None of us like to think that bad things will happen, but unexpected stuff happens all the time. The difference between a crisis and an inconvenience is if you're prepared for it. So if I have to replace our washer and dryer because they both blow up the same week, if I'm prepared for it because I actually put some money aside for those types of things that could happen, then it's an inconvenience. If I didn't put money aside for those kinds of things, now it's a crisis. Now I don't know how I'm going to afford it. Now I don't know if I have enough on my credit card. So just, maybe that's one of the accounts, right? The adversity account. You know, in my house, we have a big bill account. It's for those big bills that come due, like real estate taxes and car insurance and stuff that is only paid periodically in a course of a year. And when it lands on your front door, it's like, oh my gosh, that's a lot of money. Where do we come up with that? Well, we just make sure we sock a little bit away every month so that there it is. It's all ready. Next, start early. You've heard this. The sooner you start saving, the sooner you start building credit, the sooner you start doing some of the stuff we've talked about, the better off you'll be. Next, become debt-free. Well, there goes the whole discussion for why you're here, right? A mortgage is a bit of an exception, right? Not very many people can buy a house and not get a mortgage, or buy a car and not have a car payment, or go to school and not have student loans. But the idea of not burying yourself in debt, and eventually, maybe that's 20, 30, 40 years down the road, being debt-free, I think that's a worthy goal. Next, set goals. Stuff just doesn't happen. You're not going to save your down payment because you want to. You're going to save your down payment because you decide, I'm going to save a down payment for a house. You set it as a goal. Next, delay gratification. This is a hard one because we like our stuff and we want it now. And we can get it now if we're willing to finance it. Again, ask previous generations, when did they get stuff? Later in life, they saved for it. They didn't say, oh, I want that now, let's just go get it. They said, I want that, can we afford it now? No. When can we afford it? Well, we'll build up so we can afford it. So it's hard in our society. We're very consumer oriented. But as much as we can kind of hold off on some of that stuff, especially if you're interested in buying a home, that should probably be priority one. So all that other new stuff that could be cool to have, maybe now's not the time until you get into the house and kind of see what that costs and what that feels like. And then you can start doing some of that other stuff. So delay a little bit. Next, take responsibility, which just means that ultimately, you know, this stuff is on you, right? I mean, other than the property, and your only role there is the house you pick, all that stuff. I mean, there's nobody else that's doing that for you. So sometimes we just have to kind of take responsibility for whatever situation we're in right now, and then wherever we need to be, and how we're going to get there, and not assume this is just going to be taken care of for us. And then the last one is really kind of all of this together, just become what I call financially literate. I mean, I'm trying to share with you how to become mortgage loan literate, but there's also knowing about investments and knowing about retirement and knowing about all kinds of different things that are financially related. Just pick up ideas here and there, learn about that stuff. You know, the more you know, I don't want you to think that, you know, we should be fixated on money and how it affects us, but money is a big part of what kind of affects us in life. So the more you can understand how this works, what are the rules when you get a loan, what do you need to know about interest rates, it just is helpful to know that stuff. To not know is not a good feeling. Ignorance is not bliss in this particular case. Okay, I've given you a tremendous amount of information. And I don't want to take any more time, but I will give you kind of one final opportunity for questions. Any questions about anything that I've covered? You actually know things tonight that people who are in my business for many, many years haven't heard expressed in that way before. So you've actually got a little bit of a leg up. Well, I certainly have a big leg up on all the people that aren't here, right? Because there's a lot of people out there interested in buying a home that didn't come tonight. They don't know any of this stuff that we just talked about. Your credit union, the folks here, are really the source of not just these technical bits of information that I gave you, but how to put all this together to ultimately help you get, if it's a home, to get that. If it's something else, whatever those financial goals are. So I really, having worked exclusively in the credit union world for the last 15 years, can't say enough about the way that they do business compared to the other choices you have out there. Banks, mortgage companies, the other people out there that do some of those same financial services, they don't do it in the way the credit unions do it. So when they say you can call on them and you can utilize their expertise, take advantage of it, because they really do mean it. It's not just a slogan that sounds good. They really, really do want it. All right, so with that, I'm going to turn it back over to you, and hopefully I didn't take too much of your time.
You're good.
All right. Thank you very much, guys. Good luck. Have fun.
Thank you.
Buying a house is exciting.